So let's get right into it. Picture this, January 7th, 2026. A single social media post goes out, and boom, the entire real estate market just goes into a complete tailspin. But what if, and this is the interesting part, buried inside all that chaos was one of the most misunderstood, maybe even contrarian investment opportunities of the year? We're going to break down what happened with a company called Opendoor and explore how a policy that looked like a total death sentence might actually be its golden ticket.
And there it is, that's the bombshell. The stated goal, protect the American dream for families by stopping Wall Street from coming in and buying up entire neighborhoods. The message seemed crystal clear, and the market's reaction, well, it was immediate and it was brutal.
What happened next was just a pure, instant panic sell. All the big real estate stocks, you're talking Blackstone, Invitation Homes, the absolute poster children for these big institutional landlords, they just cratered. And in that first wave of fear, Opendoor got dragged right down with them. The stock dropped about 10%, as investors just fled from anything that even looked like a big corporation buying houses.
But then, as the dust started to settle a little, this really fascinating question began to pop up. What if the market, in its big rush to sell everything, got this one company completely wrong? What if Opendoor isn't the target of this policy at all, but maybe, just maybe, its biggest beneficiary?
And this really brings us to the core of the entire argument. See, while the rest of the market was freaking out, Opendoor's CEO went on the offensive. He basically started shouting from the rooftops that everyone had it backwards and that they weren't the villain in this story at all.
And here's the line you have to pay attention to. We don't hold the homes. It sounds so simple, right? But that one sentence gets right to the heart of this whole misunderstanding. The CEO is arguing their entire business model is fundamentally different from the companies that are actually being targeted.
To really get this, you have to know what a market maker is. So think of it like this. Think of a stockbroker. Their job isn't to own Apple stock forever, right? No, their job is to make it super easy for one person to sell their shares and for another person to buy them. They just take a little fee for making the transaction happen smoothly. Opendoor is claiming they do the exact same thing, just for houses.
Okay, so look at this. You can see the two business models right next to each other, and they couldn't be more different. On the left, you've got Opendoor, the market maker. They buy a home with one single purpose: resell it as fast as humanly possible, usually to a family. Their profit comes from the fee on that transaction. But on the right, you have the target of the ban, the Wall Street landlord. They buy a home to hold it, rent it out, and take it off the market for everyday buyers. Their goals are literally polar opposite.
So here's the mind-bending part. If you ban all the big landlords from buying up houses, who's left to give a fast cash offer to a seller that really needs to move quickly? Well, the answer could be Opendoor. This policy doesn't kill them. It potentially vaporizes their biggest competitors for inventory and leaves them as kind of the only major player in the game of providing instant liquidity to the housing market. It's wild. And get this potential political gift is happening at the exact same time the company is going through this radical internal transformation. Seriously, this is not the same Opendoor from a couple of years ago. It's in the middle of what people are calling a complete refounding. Just look at this timeline. You can see how fast things changed in late 2025. First, boom, the old leadership is fired by the board. Then, founder Keith Rabois, who's a huge name in Silicon Valley, steps back in to steer the ship. And then he brings in Kaz Najadian, the former COO who literally built the operational machine at Shopify to be the new CEO. I mean, this was a massive signal of a huge strategic shift.
And the change is it's stark. The old Opendoor, it was basically run like a tech-enabled house flipper with a ton of people and manual processes. The new Opendoor is being run like a pure software company. They are obsessed with automation, AI, and this one key metric. Not just raw revenue, but contribution margin, which is the actual profit they make on every single home they touch.
And this whole new strategy is being powered by what they hope will be their ultimate competitive advantage: an artificial intelligence engine that's designed to create, and this is their term, the Amazon of homes, a platform where you can basically do one-click real estate transactions.
And listen, this isn't just some theory or a plan on a whiteboard. In a crazy bit of timing, just a few days before that political announcement dropped, Opendoor announced a massive expansion. They now claim to cover nearly every single zip code in the entire US. And they're not doing it by hiring thousands of new agents, they're doing it by rolling out a new AI that can supposedly price a home anywhere in the country instantly.
This is what really makes their position so unique right now. While their competitors, Zillow and Redfin, have mostly pulled back from buying homes directly and are now focused on being advertising platforms for agents, Opendoor is doing the opposite. They're doubling down on building the actual tech infrastructure to buy and sell the homes themselves. If they pull this off, they might not have any direct competitors at scale.
Okay, so the story is compelling, right? You've got a political catalyst, brand new leadership, a unique tech advantage, but let's look at the numbers. And maybe more importantly, what are the risks with a high-stakes bet like this?
All right, first, the good news for them, the company is sitting on over $900 million in cash. That is a significant war chest. It gives them what's called runway, basically the time and the resources to get through this transition, to invest in their tech, and to execute this whole pivot without having to immediately go out and raise more money.
And if you look at the stock, you can see why some folks see this as a distressed asset kind of play. I mean, from a low of just 50 cents in mid-2025, it's already recovered dramatically to around $7. So this shows that while the wider market is still trying to figure out the story, some investors are already placing their bets on this turnaround.
And the new CEO has put a very concrete target out there for everyone to see. He has publicly committed to getting the company to break even on an adjusted net income basis, which is just a specific measure of profitability, by the end of 2026. This puts a really firm timeline on their execution. It's accountability.
Now, we have to be really clear-eyed about the risks because they are significant. First, there's what you could call definition risk. What if the final law is written so broadly that it does end up including companies like Opendoor? That could break the whole model. Second, inventory risk. If interest rates were to spike again, the homes they own, even for just a short period, would drop in value. And finally, there's execution risk. Shifting to an AI-first model is incredibly hard. If their algorithm starts messing up and mispricing homes, the losses could pile up really, really fast.
So it all comes down to this one powerful contrarian idea. The market panicked, it lumped Opendoor in with the exact companies it's trying to beat. The bet is that the market is just flat out wrong, and that this policy will actually clear the field for them. So what you're left with is a refounded company led by proven tech operators with a ton of cash, trading at a fraction of its former glory. Is this a totally mispriced opportunity created by political chaos, or is it a value trap waiting to spring? Well, that is the billion-dollar question that the market is trying to